Hi everyone, and welcome back to our channel. The global markets are undergoing a period of volatility with the Russian-Ukraine conflict, continued trade tensions between China and the US, progressive lockdowns in China due to the Omicron variant, continued disruptions in regional and global supply chains, and rising inflation. All of these factors have contributed one way or another to the higher energy prices that we have been seeing. Despite these external factors, the Singapore industrial leasing market is expected to remain stable given the tight supply pipeline and strong demand as the industrialists gear up for the reopening of Singapore and other regional economies. Limited logistics and Grade A office supply could see some demand gravitating towards the general industrial segment, city fringe business parks, and high-tech assets as end users actively seek prime space. Let me now share with you a quick snapshot of our first quarter 2022 results and how these factors have impacted our business. Let me start with our financials. In the first quarter of this year, the amount available for distribution registered a growth of 2.1% year-on-year to 29.3 million. Despite this higher distributable amount, net property income for the first quarter of 2022 was at 39.5 million, 10.4% lower than that of first quarter 2021. This was impacted by the surge in utilities costs arising from an increase in global energy prices and higher electricity demand. This is expected to persist for the rest of the year. DPU for the first quarter of 2022 was at 0.723 cents, 0.3% higher than that of fourth quarter 2021 and 9.6% lower than that of first quarter 2021. The latter decrease is due to an enlarged unit base from the issuance of new units, given that we completed an equity fundraising in May and August 2021. Our rental collections for the first quarter this year remains healthy at approximately 99% of total receivables. The distribution of 0.723 cents per unit will also be paid out together with a cleanup distribution at 0.187 cents for the period from the 1st April 2022 to 21st April 2022 following the completion of the merger between ESR-REIT and ALOG. The record date for the cumulative distribution totaling 0.910 cents was on the 21st of April 2022 and the expected payment date is expected to be on the 23rd of June. Portfolio rental reversion for the first quarter recorded positive 3.1% rent reversion, with logistics and warehouse, general industrial and business park sectors registering robust positive rental growth. This is partially offset by negative rental reversions in the business park retail space. Portfolio occupancy rate remains steady at 91.5% in the first quarter, consistently above JTC's average of 90.2%. We also secured a total of 305,000 square feet of space, of which 24.8% are new leases, with the rest being lease renewals. Our tenant retention rate was at 75.6% in the first quarter. Our weighted average lease expiry, as at 31st of March, remained at 2.5 years. As at 31st of March, our top 10 tenants also contributed 30.6% of the portfolio by rental income. Leasing has remained active, with new demand coming from logistics, semicon, engineering, and the manufacturing sectors. As part of our ongoing portfolio rebalancing towards higher quality new economy assets to enhance income resilience and unitholder returns, we have divested 2 non-core properties in the first quarter. On the AEI front, we announced earlier this month the built-to-suit redevelopment of 21B Senoko Loop to convert the property from a general industrial building to a high-specs asset for approximately 38.5 million. We have also secured a triple net lease at 21B Senoko Loop with the master tenant NTS Component Singapore Private Limited. Our portfolio remains 100% unencumbered, with our gearing at 39.5% this quarter versus 40% last quarter. Our all-in cost of debt has also gone down to 3.34% per annum. ESR-REIT is able to weather rate hikes with a high fixed rate hedge ratio and a well spread out debt maturity profile with no over-concentration level of debt in any one year. 93.3% of our total borrowings are on fixed interest rates over the next 2.2 years. With the relaxation of safe management measures and the reopening of our borders, these are positive factors for us to achieve greater performance, enabling ESR-REIT to cushion against the threat of higher interest rates. The industrial market is seeing healthy demand from the logistics and general industrial sectors due to an acute shortage of quality space. This was reflected in the positive rental reversions recorded for this quarter. Leasing challenges in the business park segment are expected to ease slightly as safe management measures have relaxed and people are gradually returning to their workspaces. While we are encouraged by the steady recovery from the pandemic, the global energy crisis is raising power costs for utilities. Coupled with the rising inflation, our utilities and maintenance expenses have also increased, and we expect utility costs to remain high in the near term, impacting net property income. To mitigate these higher costs, we have taken proactive steps to negotiate contracts with our utility providers. At the same time, we are also taking various measures to reduce our all-in cost of debt to manage our overall interest costs. With a larger and more diversified portfolio, ESR Logos REIT, or ELOG in short, will look to leverage our sponsor, ESR Group's fully integrated development and investment management platform, as well as its global tenant network, to attract and retain value tenants. We will also identify and improve economies of scale in managing our property expenses. As one of the top 10 S-REITs by free float market cap, ELOG will have better access to competitive sources of capital and enjoy greater funding flexibility. The enlarged ELOG portfolio will have enhanced flexibility and ability to drive sustainable DPU and net asset value growth via an increased capacity to undertake larger transactions, both acquisitions and divestments, execute asset enhancement initiatives, and manage development projects to recalibrate its portfolio into becoming the leading pan-Asian new economy REIT. With that, thank you very much for watching. Don't forget to subscribe to our channel for the latest updates. See you next time!